Life insurance is simply a financial planning tool which sole purpose is to create cash for your loved ones, your family, if in the unlikely event you are called out of the picture by death. It's as simple as that. Everything else that surrounds life insurance, the providers, the advisors, the structures, the benefits, the riders, really does complicate what is a very simple, robust, if set up correctly, financial planning tool. Everything else just complicates the situation. It's designed so fathers like yourself and myself have the reassurance that if something happens to us, there'll be a cash injection to the family to enable them to go through the grieving process, to rebuild their lives and move on with the key elements of their life as you would want them to as a father, I'm sure. You should perhaps look at a life insurance policy as a financial cushion, an airbag, something that is put into place should the unthinkable happen. Okay, so if something happens, bang, the airbag goes off and provides the cash for them to repatriate and carry on their life. Life insurance is delivered to consumers primarily in two common structures. Number one is term insurance. Number two is a whole of life policy. So number one, term insurance is for a predetermined period of time. So you decide your area of liability, so point A and B when it starts, and point B is when it finishes. So you're covered for, say, life or death as the case would be, over that given period of time. So take my example, when my daughter's born, my risk starts. When she finishes university, one would assume that my risk would be either reduced or stopped. So that's my period of time. So I took a period of time of 21 years, to the point that when she finishes university, she's going to be an educated, capable of earning her own income, provide her own food and shelter accordingly. So 21-year period of time. So a term insurance policy you can get for a shorter period of time. You can get one for 5 years, 10, 15, 12 years, 30 years, 35 years, whatever suits your individual need. Okay. The sum assured would typically stay the same throughout that period of time. So in mine, say for 21 years, the sum assured, let's say $1 million. If I die within a month of getting the policy, it pays out $1 million. If I die within 7 years of owning the policy, it pays out $1 million. In 12 years, 15, same thing, pays out $1 million. If it happens between start and the finish accordingly. What also stays the same with the policy is how much you pay into it. So at the beginning, let's say it's $100 a month. Well, it's $100 a month every single month. So it's a great little system, a great financial planning tool. You've got fixed costs and a fixed sum assured. It's cost effective, most efficient way that you can insure a risk. It's also flexible with regard to the fact you can stop it. There's no nasty surprises if you decide to stop it or cancel it. There's no commitment to pay. There's no encashment values to consider. There's no penalties or anything like that. It's clean, it's simple, it's cost effective, and I think one of the best ways to insure a risk or liability. The second way that you may consider is with a whole of life policy. A rather more complex structure. Some people like them. They can be useful in some situations. Now, a whole of life policy, as per the description of it, or title as it were, runs for the whole of your life. So if you took one out tomorrow, you could design it so it continued until such time as you die. Now, you might die tomorrow. You might die when you're 50, 70, 90 or 100. But a whole of life policy, the classic true form of a whole of life policy, is it keeps going until you die. So there is effectively a guaranteed payout. But of course you'll pay a premium for that. You know, everything, you get what you'll pay for, as it were. So the cost of a whole of life policy is going to be significantly more than a term insurance policy. On the upside with a whole of life policy, it's going to create some encashment value. It's also got a number of additional benefits that you perhaps can't put onto a term insurance policy. But there are some I would argue, some inherent risks or considerations with a whole of life policy. You know, when your money goes in on a monthly basis, part of that money goes towards covering your insurance risk, and the other part of that money goes into an investment structure within the policy. The concept being that that investment money will be fed by your additional premiums going in, but also that it will grow over a period of time. The idea being that it creates an encashment value within your particular policy. So ultimately, in 10 or 15 years' time, you may have an encashment value with that policy. I don't think it should be confused and considered to be an investment. In my opinion, it's very much an insurance policy that has an encashment value. Some pros and cons to it, fairly complex, but it might be okay for some people. So that is your basic two structures for life insurance. As I say, there are variants within the marketplace, but I think they're the type of things that you might consider, or at least do your own research into accordingly. Really, the next thing you need to be thinking about, perhaps, or that may already be on your mind, is whether you actually need life insurance. You may be on the fence as far as that situation is concerned, or that consideration rather. So it's not for me to tell you that you need life insurance. Obviously, you need to consider it yourself. But if I could give you some pointers as to what you might consider as to reasons that you want life insurance, maybe that will help you. So really, if you have dependents, so particularly dependents of a school age, well, you know, if something happens to you, who's going to look after them? Where's the money going to come from? Be it schooling, shelter, future education, etc. Other reasons that you might consider life insurance is for your partner, subject to their professional income currently. You know, if they're earning less than you, then maybe there's a shortfall for the family, so you might consider life insurance. Maybe they don't work. Maybe they choose to be a stay-at-home mum, so maybe you've got to consider providing for your wife and the children until such time as the children leave school, and maybe even also for your wife's retirement plan. So all things that you can think of yourself and consider whether you need life insurance. Two other ways that you could use life insurance. One of those is, of course, to cover any debt. So whereas here in Dubai, of course, whenever you take a mortgage, you get insurance with it, or you have to take insurance with it. But of course, in the UK, as you'll know, you don't have to take insurance. So if you've got property in the UK that has a mortgage on it, you may consider putting a decreasing term policy against that debt. So if things do go wrong, that property is paid for, and of course, by default, creates a home, a paid for home for the family to live in. What's fast becoming a popular way to manage inheritance tax planning is, of course, with insurance policies. So as property prices continue to creep up in the UK, what we're finding, of course, is that the tax barriers or tax allowances are not rising at the same level as the property prices. Therefore, what I would describe as normal families are being hit with inheritance tax bills, something that we used to consider for the rich and famous, but now really Mr. and Mrs. Smith is being affected because of the property prices taking them over that barrier. So once you've understood your inheritance tax dues, as it were, let's take an example. Let's say you've worked out your net asset value, as it were, and let's say your tax bill will be £300,000. Or what you could do is you could take out an insurance policy that would ensure that the taxman is paid. So rather than giving that problem to your family or loved one or children, you could work out your tax plan, put a policy in place, and let the insurance policy pay the taxman. That's without question the best deal you'll probably ever do as far as dollar for dollar is concerned. So the last element with regard to perhaps why you would, or how rather you would think about, if you need life insurance, is you've got to play a bit of a scenario or role play game in your mind, as it were. So may I suggest you do this? Have a think about the implications or the consequences or the effect of a certain incident. So if you don't go home tonight as a result of a fatality on Sheikh Zayed Road, your fatality, what would the family do? Now you've got obviously a couple of elements there. You've got practical elements and you've got emotional elements, and of course time would be a significant element. But the emotional just set aside just for a moment, practically what would they do? You know, how would your employer react? What sort of support could you expect from your employer? What's the current state of your finances? What would be the aims and wishes of your wife and your children? Are the children about to take exams? Do they need to stay in Dubai? Do they need to get out as quick as possible? But really have a think about what resources are available to the family, what the family's plans would be, where they're going to repatriate to. If it is back to England as an example, or where are they going to live, what car they're going to drive, all those different things which I'm sure you can work out. Whilst you're doing that, what you'll also find is that starts to create the building blocks, or at least the understanding of how much life insurance you actually need. That's a subject that we'll just park for the moment, and I'll produce another short video for that. But as I say, take yourself through that particular process, understand what the implication or the consequence or the effect of you not going home tonight, and indeed what your aims and wishes are for your family, what support they need, what financial cushion or airbag. That's it. The rest is down to you. Any questions, drop me a line.